Yes, welcome guys. Once again, this is Pips Institute. Welcome to my channel. If you are new, please kindly subscribe to my channel and turn on the notification bell so that you can get notified of any videos at Pips Institute. Yes, guys, this is a part two of the M's and W pattern which we have been dealing with since last week. So this is the part two of it. And if you have not watched the part one, just kindly click on the title up on your screen. That will be shown to your screen right now. Just click on it to watch the part one. Then you can come back and watch the part two. So that being said, let us dive into today's training properly. Yes, today I'll be talking about a very important aspect of M&W, which I think or which is very important that you all need to understand so that you don't just trade M's and W's blindly and then take all of them for the same thing. Yes, there's a type of M&W which I call the intraday or intra-week or intra-month or intra-year M's and W. So what do I mean by that? I'm going to make an illustration here. Yes, follow me as this line on your charts, you will see this kind of lines that demarcate your chart. They are called period separators. That is, they help to separate your periods, your time frame. Like if you're on the 15-minute time frame, then when you see this line, it is a daily 84 hours time. That is each of these line signifies 24 hours on a 15-minute time frame. Sorry, and it signifies on and it signifies a weekly time frame on your 4 hour and a monthly time frame on your day one on your daily time frame and yearly time frame on your monthly time frame. I mean yearly period separator on your monthly time frame. So now that being said, what do I mean by an intraday M and W? Let's assume that the market is giving us a lower low. That is, the market is going down, going down. Then the market gets here, then moves here, come back here, then moves here. This is what we call an intraday MOW because the first leg of the W forms at this day, then the second leg forms at this day. So the first leg, this is the first leg over here. Now this is the second leg. The first leg did not form at the same day, unlike like you just have something like this. Like if you have something like this now, it forms at the same day. You understand? But this one it is different because it forms at this day one and this day two. So it forms at day two. So you can expect that once you see this kind of formation forming at day two, I mean, first leg at day one, second leg at this other day. Please, this does not have to do with any kind of trading session you are into, be it the Asian session, be it the London session, be it the New York session. It does not matter. But what you are just after is that the first leg forms at another day and the second leg forms at another day. Then this is a powerful M or W formation. I know what I'm saying. This is a powerful M or W formation, which I want you to take note. So once you see this thing, then you can anticipate a reversal coming up. So once you see the M formation forming, then at this point, it's likely that you are going to see an indecision candle at the second leg. After the indecision candle forming here, then the next thing you're looking at, you're looking for a reversal pattern or a reversal candlestick, which can come in form of a an engulfing candle, a pin bar, That is a double pin, a tweezer, or anything that has to do with but it's a candlestick formation that has to do with a reversal pattern, then so you are expecting that the market should move up, then taking a profit at around this place. Now, in such a case, once the market moves up, this is at a level. This is a level which the market broke. Then, if you are unable to enter the market at this place, then you are looking at the market to move up. As it moves up, you're expecting it to come down to retest this same level. That is in case if you miss the entry point at either this place or this place. Once it breaks this level, then you are expecting the market to come down, retest this same level, then you're expecting it to continue going up and up and up and up. How you get what I'm saying? So then get to this place. Then at this point, you are going to take your trade at this point, then your stop loss should be at around this place. But if you take your trade at this point, or if you take your trade at this point or at this point, so you are expected to put your stop loss at the low of the W formation, which will be around this place, TP around here. So that's that about that. So that being said, let's look at the M formation. So after the market has gone this, and then we are here, then you see the market forms, excuse me, then you see the market gives you a first leg M, then at the second they moves up, then comes down back. At this point, this is an intraday M formation. So you are expecting the market to start selling because it was giving you a previous higher high. Then at this point, it's now giving you a what? Once it gives you this kind of formation, then you are looking at the same thing that you looked at this place. That is, you're looking at, you can start at this point, you are going to begin to see some pins to the upside, that is candlestick formation that is showing a reversal, like a candlestick formation like this. Let me just draw it. Candlestick formation like this. Again, I'm saying, so you are expecting this kind of formations. So once you see this kind of pattern forming, it can come in form of a doji, but it must show an exhaustion of sellers, of buyers rather, signifying the emergence of the sellers in the market. And once you see that, and once you will know that the market is about to reverse. And please, I want to make this point clear here. Please, the M's and W's, they might not be perfect, but they are there. And I'm saying they might not be perfect, you might not see them perfectly from, but once this is the best way that you can know this is an M. If you are able to spot them easily, you're able to say this is an M, go for it, it's an M. But if you're not convinced enough that hey, this is not an M, then it is not an M. Don't force it. You don't have to force the market, because the more you force it, the more you burn yourself, because you cannot force what is not in the market. You cannot force the market to suit you. No, rather you have to flow with the trend of the market. I get what I'm saying? So please don't just force it. And mind you, sometimes the hem, it might, if I look like this, the W or the hem might look like this. It might look like this. Okay, it might give you an equal M. So whichever way it is a W. And the same thing with an M, it might look like this, and it might look like this, and it might be equal. And as a matter of fact, something like this, a W like of this magnitude and of this magnitude are always considered very, very effective. Why are they always considered very effective? An M of this magnitude are always considered very effective than an M or W with equals first leg and second leg. Why? Because if with the M and W of this magnitude, if you are to use your oscillator or your TDI or any oscillator indicators, it's likely going to show a divergence, which means that there's divergence between the price and the oscillator, which is signifying a change of trend. That's another way of knowing that there's going to be a change of trend in the market. So that's just another teaching for another day. I just have to, that's not what we are talking about here, but I just have to say that so that you can understand how powerful M's and W are. Do you understand? So that you don't just go and look for just this type of M and W's alone while neglecting the other one, thinking that they are not M's and W's, but they are still M's and W. So then at this point, so what do you look at? What are you looking at? Once you begin to look at this thing, then you are looking for an engulfing, bullish engulfing candle to engulf. Once it engulf, then you enter either here, and if you have fortunate, you can even enter at the close of this spin back. You begin to see this spin, even if it's one you saw. In as well as it is an intraday M and W, then you can expect that it is going to give you a good setup. They are always powerful. Then we are expected that the markets should keep on moving down, moving down, moving down, and moving down. So that is that about M's and W. And this M and W, the intradays M and W are very, very powerful. They're powerful M's and W, very, very powerful. So they are. I'm not saying that it is going to fetch you. It is an holy grail strategy. No, what I'm saying is that if you are able to spot these types of M and W's, at least 7 out of 10 trades are going to play as you anticipated, if not even 9. So it is a highly powerful tool in as much as your stop loss are in place, and take profit are in place. I'm telling you, if you're able to get 7 out of these trades or 8 out of these trades, then you profit. Even if you're able to even if you're able to get like 5 set up like this, and then maybe out of 10 setup, 5 of them came in profit, you will still be profitable at the long run because your risk to reward ratio is high. Imagine setting a stop loss at around this place. Imagine setting a stop loss at around this place and a TP at around this place. A stop loss at around this place and a TP at around this place. How can you see the risk to reward ratio? Very, very high. Okay, so like this place now, I told you that once it breaks this place, if you're unable to enter at this point or at this point, then what we're expecting is that if it breaks this level, then you're expecting the market to come back, push down, retest this level, then you enter and your stop loss will be around this place and your take profit will be at around this place. So that being said, I hope you understand this concept. So this is just in the drawing phase. So let us dive into the chart and look for an example of this type of intraday M's and W. Okay, guys, this is the Euro JPY, and this is the 1 hour time frame. Please don't forget, I said that it does not really matter any time frame that you look at this setup from. You know what I'm saying? It can be on the 5-minute time frame, it can be on the 1 minute time frame, it can be on the 15 minutes, on the 1 hour, on the 4 hour, on the 1 day, on the 1 month. But what we're looking for is either an intraday M and W, depending on the kind of trader you are, or we're looking for an intra-week M and W, or we're looking for an intra-monthly M and W, or intra-yearly M's and W. I hear what I'm saying? So it does not matter the time frame you're in. But one thing is that this thing always show up in every time frame, day in, day out, in every pairs. Don't take my word for it. Do the back testing. I'm just going to focus on this Euro JPY. Then you can call it a day so that then I can leave you to back test it because I can even see a buy and a sell right on this Euro JPY with the intraday M and W. The 1 hour is an intraday time frame. All these lines you are seeing, these are period separators. All these lines, these are period separators. So it signifies 24 hours each. So each candle is forms at the end of 1 hour. So let us now, if you could agree with me that this is an uptrend, right? Now look at where we are presently. what the market did. Then we have first leg. Can you see that the first leg formed here? Then second leg formed here, and then down we go. We are looking at setting our take profit at around this level. I'll be looking at take profit around this level because this is the low of the previous day. This is the low of the previous day. So this level is our stop take profit, and our stop loss will be above, a little bit above the high of the hem. So as you can see, now the market already broke this level, this structure over here, which I told you that if you are unable, look at these pins to the upside down over here, this is a pin to the upside down, a bullish pin, signifying what? That if you have to use the VSA, the volume spread analysis, there will be a divergence between this bullish pin side up to the pin side with the VSA. It's going to show a kind of small volume but high spread. We're using the VSA. This is going to be a high spread. This is a high spread but small volume, which signifies a divergence. And whenever you see a divergence, it signifies that the price is about to change. Okay, so even with the likes of once this bullish engulfing candle forms, then with this pin to the upside down, then you're looking at selling at around this place. Once you sold and the market gives you this, don't forget this level, excuse me, this level over here, this level here is another entry point. So once you can see that the market just gets down, then what the market do again, it comes up to retest this same level. So if you did not enter at this candle over here, which will allow you to place a stop loss at around this place, then the market is giving you another opportunity to enter even at this level. You can see that you begin to see in the candle some pin bars around this level. Then what do? You sell at this level, then your stop loss is above the highs of this place. Then your stop loss is still, your take profit is around this place. Your stop loss it is here. Then down you go. Then you can see the market gives us a pull down and smash our TP. What's it? So if you have to go back to the 15-minute time frame, this kind of chart is going to give us a multi-day. You're going to see it clearly though, but that's so. Now let's look for the W formation. Now when we get it, the market is clearly giving us a downtrend, right? After the market giving us a downtrend, then in this day, what the market does, the market comes down here, right? Moves up, comes down a little bit. Sorry. Then moves up, market moves up here, then comes down back here, and then up we go, giving us a W formation. Probably this is not really right. This is how it did. Yes. Yes, exactly. This is what the market did. The first leg of the W formation formed at around the days which is formed is quite very different. It's formed. The first leg was the previous day. The second leg formed at this previous day. Then what are you looking at? Then you're looking at entering your trade. Let me undo this aspect so we can see the charts clearly. Okay. Now look at this place. You can see the doji, the pin bars here. Then what do you do at this point here, which this is an engulfing candle that engulfs this pin bar, the bullish engulfing candle? What do? you look at buying immediately at this close of this engulfing candle. You buy, then you set your stop loss at the low of this place. Then your stop loss should be around here. And your take profit, you're looking at your take profit, either you set your take profit at around here or at around this level. And then what did the market did? The market then give us this, then goes up, unable to break this level, this strong level. Then the market comes down again, then comes up, then comes down to retest this level. I told you, if you're unable to enter at this level, then the market is going to give you an opportunity when it's going to retest this area here. So once the market retests this area then here, then look at what it did. It came exactly to retest this same area. Then you're looking at what? At entering in at this area, giving you another opportunity. Look at this. Let me undo those. Now, look at this initial candle forming. These are just clues that cannot be overemphasized. So you're looking at buying it at around either this close of this place, or looking at an engulfing candle. Once the engulfing candle forms, you buy here, or even all these pins to the lows. This pin over here, the pin here, the pin here, showing that the market is about to reverse. Then you buy, and then your stop loss is around the low of this place. Then your take profits is around here or here, and then we go, and then you go, you have your trade. So I hope you guys have learned some or two things about in this video. I hope it's educative enough for you to be able to form your strategy around this. Please don't complicate trading. Once you complicate it, you'll be confused. Once you cover your chart with a lot of indicators, you'll be confused. Can you see the screen, my screen here? There is no indicator at all. Just pure price action, just analyzing what the buyers and the sellers are doing, what the market makers are playing around with. That was how we arrived at this point. Just keep it simple. My aim is to give you a simple trading strategy, STS, that you can use in making money without hassle free. I mean, that you don't have to get it complicated. Just simple trade strategy. So I hope you've learned one or two things. Please, I'm not saying that this is a really great strategy, mind you, but I'm saying that this is a strategy that can make you money if you are consistent in it. If you've not started spotting M's and W's now, when you want to start at first, it might be very, very difficult for you. Okay, so don't eat yourself hard. That I'm not saying this in years. It's always so for a first timer. It's always so for a first timer. So, but the more you practice, the more you learn. At least it was not the first day you started trying to work that you began to work. Sometimes you fall, sometimes. So the more you get your eyes acquainted with the chart, the more you begin to see this pattern clearly and visibly. Someone like me that have been using this strategy for a long time now, it's very, very easy for me to see all this kind of pattern and then using them and then once I spot it early, I enter it because I've mastered it. So you have to keep on practicing, and then please, like I said, don't take my word for it. Backtest it, and then you will see that it's a profitable um, strategy at the long run. I promise you, 7 out of 8 trades are going to come out. I mean, 7 out of 10 trades, 7 to 8 trades out of 10 trades are going to come out the way you anticipated them to be, using the M's and W pattern formation and everything I have taught you here. So, guys, if this video has helped you and has broadened your knowledge on trading, please make sure you like and comment on this video. Please don't forget to like and comment on this video. And if you have not yet subscribed, please kindly subscribe to Pips Institute as I'll be uploading more content about how to trade the market profitably. And you can make suggestions on the kind of topic you want me to cover, and I'm going to gladly do so. Thank you very much, guys, for giving me your time and for giving me your yes. And I just want to say, don't stop learning, because the moment you stop learning in this game, then you are ready to I don't know. Once you stop learning, because the market is ever moving, so you have to keep on learning and then you have to keep on getting understanding. So until I come your way next time, take care of yourself and bye for now.